Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. At the close of business on Wednesday, after another big rate hike from the Fed, and some argue the hike should have been higher, even much higher, there was hope that we would finally see a shift in recent trends in mortgage rates. Rates had been rising quickly since the beginning of August, but accelerated to a troubling pace after last week's Consumer Price Index, or the CPI release, a key inflation report that guides decisions of the Fed. CPI did extra damage because it was much higher than expected and because it happened so close to the scheduled Fed announcement. A similar scenario had played out in June, resulting in the biggest three-day jump in mortgage rates in decades. In other words, high inflation spooked the market into thinking the Fed would signal an even firmer commitment to its rate hike outlook. Not only did that happen, but in the Fed's forecast summary, there was a strong shift in expectations toward even higher rates in the coming months and years. This is what I've been saying for months. If you think you need higher Fed funds rate in the future, then rip the Band-Aid off and do it now. It's easier to bring the rates back down than to prolong a recession with higher rates. The faster you enter into recession, the faster you'll come out of one, and it will be a shorter recession. Now granted, the members of the Fed can't begin to guarantee or even reasonably predict that rates will be as high in 2023 through 2025 as Wednesday's forecast suggested. But if they had to guess at those levels based on what they know today, those are their guesses. Fed Chair Powell has repeatedly reminded traders not to put too much stock in those rate forecasts, but to no avail. The average Fed member sees the Fed funds rate at a full 1% higher by the end of 2023 than they did when the last batch of forecasts came out in June. That would put the Fed funds rate at 4.625% by the end of 2023, and then slowly down from there. Currently, the Fed funds rate is at 3 to 3.25%. And for anyone who doubted the disconnect between the Fed funds rate and mortgage rates, let's consider the following. The Fed funds rate is now 0.75% higher than it was when the last forecast came out on June 14th. The highest median forecast among Fed members is now 1% higher than it was on June 14th. Despite all of that, Wednesday's mortgage rates were nowhere near 1% higher. They were actually much closer to June's levels. The market made it through what they thought and seemed to be bad news for rates from the Fed, with rates actually moving a bit lower. The more optimistic hope was that such a ground-holding event could serve as a turning point in a brutal march toward the highest levels in 14 years. But everything changed on Thursday. Boy, did it. The bond market had massive second thoughts about Wednesday's resilience. The underlying reasons for this remain a matter of debate among market participants, but we can see at least one piece of evidence that overseas bond markets played a role. Specifically, bonds in the UK got destroyed in the second half of the week for reasons that had to do with the confluence of a new budgetary announcement affecting UK bond supply and the as-expected announcement of bond sales by the Bank of England. Ultimately, you don't really need to understand the details as much as you need to see how different the movement was between US and the UK 10-year government debt, the quintessential benchmark for longer-term interest rates in their respective countries. The following chart shows just how much each 10-year rate has moved last week. The discrepancy here is hard to overstate or overappreciate. This is an absolutely massive liquidation in a market that always has some measure of spillover onto rates here in the US. In other words, we very likely would not have seen US rates shoot higher nearly as quickly if not for the going-ons in the UK bond market on Thursday. Therein lies my new hope. It's not a forecast or a prediction, just a glimmer. UK rates jumped even faster on Friday, and US rates paid even less attention. All other things being equal, this could be seen as a sign that traders in the US are finally sensing some exhaustion in what has certainly been an exhaustive effort to push rates higher over the past 2 months. Now, for the record, we're talking about 10-year government bonds because mortgage rates correlate very well with government bonds, and government bonds give us a fair or far superior way to compare rate momentum between these two countries. Also, for the record, rates are still really high and the rate landscape is a relative mess. In fact, there's no perfect way to relay the current position of the top tier 30-year fixed rate because it varies greatly depending on lenders, pricing structure, and the borrower's pricing preferences. The big issue is the presence of upfront costs. They're unavoidable in many cases. In other words, lenders use them to offer clients a way to buy down to a lower rate. And to be sure, while points or buy downs aren't good or bad, they are an interest expense in the same way in the interest portion of your mortgage payment is. You're just paying for it up front instead of over time. All that to say that the rates appearing on many news headlines are hopelessly low. Freddie Mac's weekly rate survey just came in at 6.29% on Thursday. Not only does that require almost a full point of upfront costs, it's also very stale data at this point. If I could magically remove the mortgage market's ability to rely on points as a part of the rate quote equation, the average lender, and I'm not the average lender, is now much closer to 7% than 6.29% based on actual daily rate offerings analyzed right up through Friday afternoon. While it's true that the pain of higher rates is the pain the Fed wants us to feel in order to fight inflation, the market may soon sense that the Fed has done enough to accomplish the desired shift. Even if the Fed isn't as quick to admit it. It's definitely noble to fight inflation, and as the Fed says, it's definitely dangerous to do too little to fight it as well. Here again is the argument to raise the Fed funds rate more aggressively. But what do I know? It's absolutely true that mortgage rates near 7% are already doing plenty to fight home price inflation. If the Fed begins to think that 7% rates would do enough, today's glimmer of hope would increasingly prove to be justified. Otherwise, rates will continue up and over 7% until one of two things contract noticeably. That's inflation or the economy, or worst case, both. And let's hope that doesn't happen. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.